Hey, my name is Josh Walker. I'm one of the owners of Arid Investing, and this is the Good Money Podcast. This is Asset Types Part 2. So, in the previous episode, we covered multifamily, small and large, and mobile home parks. One of the reasons, just to hit on it one more time, that we want to go through some of the most common asset types that you have available for you is because as a syndicated investor, you have so many options available to you. You need to understand what's out there. So as I go through these, be thinking about the pros and the cons of each one and whether or not they have a place in your portfolio. Think about the cash flow, think about the upside, think about the downside, think about are they recession resistant, what's the growth over time, all those kinds of things, and see if this is something that you might want to work in. Some people want to do multifamily and nothing but multifamily forever, and that's great. But some people want some exposure to a few other things. And so we'll go through some of those things. So again, we covered multifamily in the first one, and those are some of our favorites, and those are some of the most common. And we kind of think of those as foundational. They have they have a very good balance of all the four pillars that we talk about. So cash flow, growth over time, tax advantages, and velocity of money. They're kind of foundational. Each one is pretty balanced. Some of these are way higher on cash flow. Some of them have more tax advantages and on and on. So if you want more information on the multifamily, go back to episode 9, check it out. So let's get into some of the maybe less common things that you might want to incorporate. So first one we'll hit on is self-storage. Self-storage is something that I think everyone should consider. For the main reason is that they are extremely recession resistant. So going all the way back to 2007, 8, 9, when the real estate world took a dive off of a cliff, self-storage was the one asset type that stood out amongst everything as being extremely recession resistant. In general, people don't want to go get their stuff. They don't want to move their stuff out of one storage unit and into another, and they certainly don't want to go get rid of their stuff. That's why they have it in a storage unit to begin with. So this asset type has exploded over the past decade or so. Institutional capital, REITs, hedge funds, and the like have moved into this space in a big way. So most of the larger assets, the larger facilities are going to be gobbled up by institutional capital. We've talked about how you don't want your sponsor competing with institutional capital. They just simply cannot win, or it's very, very difficult. I hesitate to say they can't win. It's very, very difficult for an individual sponsor to win when they're bidding against institutional capital, just because they're willing to stomach almost no cash flow. And that's something that most sponsors just don't want to invest in. And certainly investors don't want to invest in a zero capital, zero cash flow early time investment. But there's still opportunities out there. There's still a lot of mom and pops, especially with the smaller facilities. Another thing to think about is raising rents on self-storage units, for lack of a better way of saying it, is easier than raising rents on apartments, large or small. So let's say you have a facility and you have 50 units, and the average rent is $100 a month for each self-storage unit. Typically have a few different sizes of individual units, but let's say the average is rents for $100 a month, and you want to raise rents 5% each year. So if the average is $100 a month, if you're going to raise rent by 5% each year, that's $250 a month total. That's $3,000 a year. That's not insignificant, but each renter is only seeing an increase of $5 a month. No one is going to be motivated to go move their stuff for an additional $5 a month. Self-storage units also have relatively low overhead or low expenses. There aren't a ton of people you need to employ to run these. A lot of them can be run completely remote. There's no tenants, there's no toilets, there's just less stuff to maintain. So self-storage units, we are big fans of, and we do think pretty much everybody should at least consider it. So we'll move on to single-family rental portfolios. These are generally viewed as not as efficient as multifamily. There are more roofs, there are more walls, there are more fences. There on the plus side, there is less turnover. So in individual single family rentals, you have less turnover than you have in your typical apartments, large or small. There's likely less long term growth due to a smaller pool of eventual buyers. Apartments, small or large, there's a ton of people who want to get into that space. There are just less end buyers for a portfolio of single family homes. Flips are interesting, and we've done this on our own. There are tons of people that do flips. There are less people that do them from a syndicated standpoint, but think of it as a scaled down version of a small apartment value add deal. It's about as scaled down as you can get. There can be a lot of upside if it's done right, but you're extremely susceptible to market turns. So these certainly have their place, but the biggest drawback is that they are just less efficient than your typical multifamily deal. We tend to rank most multifamily deals over this, unless you just have an unbelievable sponsor. Another one to consider is industrial deals. So think warehouses, places where companies like Amazon store their stuff. These have exploded over the past 5 years or so. Really, COVID sent them through the roof with all of the direct to consumer services. Almost anything now has a direct to consumer option. So warehouse space is generally in low supply and high demand. Institutional capital, again, is becoming more and more interested here, especially on the larger facilities. You typically need a very large space and you're going to have very few tenants. So this can be good and bad. It's good if you have great tenants who have a thriving business and long leases. It can be very, very hands off. It can be bad in that if you lose one tenant, you're going to lose a very high percentage of your leased space and a very high percentage of your revenue. But again, if you can buy these from mom and pops, or you can start these from the ground up and then eventually sell them to an institutional buyer, these can be extremely prolific and provide a ton of upside on the back end. And they're pretty average from a cash flow standpoint. Office buildings, this is something I've invested in one, and it's doing fine. I invested in it pre-COVID. Obviously, COVID kind of killed office buildings as a whole. Each deal is unique, so these can be pretty high risk. There's way more risk on them today than before COVID. Now that work from home is so prevalent, but if you can step into it and there's line of sight on some anchor tenants and some long-term leases, it can be a decent long-term play. So from there, let's talk about commercial and retail. So these are very susceptible to the direct to consumer trend. So if you're going to do something, if you're going to invest in something like a strip mall or some kind of retail space, think about the things that where you have to have a person in that building, something that can't be killed by the direct to consumer trend. So things like dentists, hair salons, nail salons, doctors' offices, chiropractors, all those types of things have to have a physical building. Amazon's not going to take over chiropractors. So from that standpoint, there's still a place. There's a lot of study that needs to be done on the market and what's the demand. So again, they have their place, but there's some risk there. Hotels have tons of ebbs and flows. I've invested in one hotel. I invested pre-COVID. It got destroyed during COVID, and it turned out to be an average deal, thankfully. But these just got hammered in COVID. It's basically corrected itself, but these are very, very dependent upon hotel management and customer service. So I don't even really put these in the same. A lot of people try to lump them in with multifamily. I see them as completely separate. This is customer service, a completely separate thing. If that's something you want exposure to and it's in the right market, I wouldn't hesitate to consider it, but know all the risks that are involved. Another one that's different than pretty much anything else that we've talked about are neighborhood developments. So the benefit of neighborhood developments is there can be a ton of meat on the bone. There can be a ton of upside because you can buy land relatively inexpensively. You put in all the work to it and you greatly increase its value when you can take 40 acres and then turn it into something where there are 50 or 100 homes that you can sell to builders. And builders right now are having a hard time finding lots. They're not making more land, so the supply and demand thing can be on your side. These take a long time. These take 3 to 10 years. A lot of times, these can take 3 to 4 years before you can ever sell the first lot. Again, there's tons of upside. There's tons of work. You're also really susceptible to the market. So while there's generally an overall housing shortage nationwide, this becomes a hyper local thing when you're talking about 40 acres in a single market. And that can change a lot from the time you invest to the time that lots are ready to be sold. And beyond that, there are a ton of nuances to neighborhood developments. So you need somebody who is very experienced and knows what they're doing. House flipping, we talked about this a little bit earlier. This is all dependent upon the sponsor, upon the GC. They have to be able to find really, really good deals. Essentially, that it comes down to finding really good deals and being very efficient at it. They can be hugely impacted on the amount of time that it takes to rehab, changes in market conditions. But essentially, you need somebody who has a tremendous amount of leads and they can buy it right. So beyond all of those options, let's talk about a non-real estate option. And this is something that we've raised a number of funds for, and I've personally invested a fair amount in, is ATM machines. And initially I saw this come across and I blew it off and I thought, this sounds gimmicky. I'm not going to mess with it. And as a side note, I know the M in machines stands for machine, so I'm saying automatic teller machine, but ATM, leaving it without the machine just sounds weird, so we're going to call it ATM machines. So what I love about these is it's essentially buying a stream of cash flow. The deals that we have done have been for replacement machines. So over time, these machines life out and they need to be upgraded. Those are the funds that I've invested in. The kicker to these is on the tax side. So with these funds, 100% of the investment goes to that tangible asset. So you can take advantage of a ton of depreciation and specifically bonus depreciation. So last year, this is being recorded in 2023. 2022, you had the option to take bonus depreciation, get 100% of your depreciation in year one. So if somebody invested $100,000 into one of these funds, you would get a K1 the next year that said negative $100,000. That is a huge, huge benefit. So if you had $100,000 of separate passive income, you could offset that completely by investing $100,000 in this deal. In 2023, bonus depreciation is down to 80%. It goes down to 60 and 40 and 20 and eventually goes away each subsequent year. There's also a lot of talk on these kinds of deals as far as, are we going to a cashless society? So maybe eventually long term, but one of the things that we've learned is while the percentage of cash transactions each year does go down, the amount of total cash transactions does not go down nearly as much. There are simply more and more transactions every year. There's also a ton of transactions that you typically don't think about, things like EBT cards. So these are for non-banked people who get funds from the government. They get them on what's called an EBT card, and ATMs are the main way that they get that cash. Going back to the depreciation side also, there's no depreciation recapture. So you can take all that depreciation on the front end, and if there's a problem with doing that on other types of assets, when you sell it on the back end, at the end of the life of the deal, you have to recapture some of that appreciation. It can take away from some of the profits. Here, there's no sell at the end. These machines just sit and eventually life out, and there's no sale at the end. So you just get all that appreciation and you keep it and never have to give it back. Separate deal we'll talk about that's separate from all of these are investing in businesses. So this is a wildly different risk profile. The number one thing here is you need a great operator. You need to know that they have experience running businesses ideally running this type of business, but the risk profile is just wildly different. There is unlimited upside. If you are getting equity, and these can be structured again however the sponsor likes, but if you're getting actual equity in a deal, there's an unlimited amount of upside. The flip side to that, that's different than investing in real estate. So real estate typically has some amount of upside capped, although it can be high. It's hard for real estate. It's very, very hard for it to go to zero. A business can 100% go to zero. So there's also a huge difference in buying a startup or investing in a startup and investing in someone who's buying an existing business. There's a lot more risk that comes from a startup, and your upside should offset that. You should have a ton of available upside. That's more like venture capital versus buying an existing cash flowing business that's much more de-risked. So we'll eventually do an entire episode on investing in businesses. We like it on the whole. We love that the upside, and done right, this could be a game changer. But we'll cover all the details in a separate episode. Another one that's popped up a lot recently for a specific reason are car washes. And that's not anything that I had considered investing in until a year or two ago. And the thing that changed everything with car washes is the membership model. It's likely that there's a car wash near you that has the option for you to have a membership, and you pay somewhere between $10 and $30 a month for unlimited car washes, depending on how fancy you want the car wash to be. But that has shifted everything with car washes, because tons of people will pay this $10, $20, $30 a month and never come get a car wash. You are just not nearly as dependent upon people seeing it, turning in, actually washing their car. Now it's just getting people to sign up, and it's this recurring model that a lot of times people, they may go years and not use it, but never cancel it because it's 10, 20 bucks a month. So these can be very lucrative if you're buying them from a mom and pop, which is not set up on a membership model. It's very inefficient, just like a lot of the other things. It's always good to buy from a mom and pop. They're also very recession resistant. Regardless of what the economy looks like, people need to wash their cars. A lot of equipment comes with these, and oftentimes the real estate underneath the car wash comes with them. So this can help from a depreciation and thus a tax standpoint. Beyond that, there are a ton of other things out there that I don't have the experience to dig into. There's flipping raw land. There's buying notes, mortgage notes. There are people who do amazing things in parking lots. That's an interesting space that I'm learning more about. But those are the general, that's a list of 10 or so things going all the way back to the previous episode that are worth considering. And again, you don't have to know everything about each one of these, but know the risks, know the rewards, know what you want to get into. Are you looking for cash flow? You're looking for tax advantages. What's involved in all of these things? And maybe it's something that's got enough upside that you want to allocate 5% of your portfolio to something that's got low cash flow, but man, it might 6x, 8x, 10x over the next 5 to 10 years. And that's worth it. You want to put yourself, in general, it's not a bad idea to put yourself in a position where a few years down the line, now, if those deals pan out like you hope, amazing things can happen in your financial world. So as you think through each one of these, think about how you want to build out that portfolio. So if you want more information like this, go to areteinvesting.com. That's ARETE investing.com, and sign up for our newsletter. There's an amazing download that you can get that tells you everything that we cover in general on syndications in one single takeaway, one single document. And we would love it if you would rate and share this podcast. We want more and more people to know that these kinds of deals are out there, know that they have the ability to invest in something outside of the stock market, that with all the flaws in the stock market, there's a flip side to that. And we love getting this information out there. So if you can share this with one person, if you can put a link to this on your Facebook page or your Instagram page, we would absolutely be eternally grateful. And hit us up if you have any questions. Talk to you later.